Breaking news. Government spending has put the U.S. into an economic doom loop, and average Americans will pay the price.
Now, that may have been AI, but what she was saying was not fake news. The United States has definitely entered an economic doom loop, and if you have been investing using traditional methods like buy and hold, buy the dip, you're likely going to get crushed. I'm going to explain exactly what is happening, and at the end of this video, I'm going to tell you how you can survive and thrive in these crazy economic times we're living in. I'm going to reveal all of this to you in 3 simple, fast steps. Step number 1, let's go over the government spending as a percentage of GDP. My good friend Lynn Alden says nothing stops this train, and she couldn't be more correct. Let's look at a chart from 2020 going all the way back to 1934. In fact, we go back a little further than that, maybe 1930, call it. On the left, we go from 0% up to 50%. Now, everyone talks about how much money the federal government spends, but they forget to talk about how much money state and local governments spend. So when you combine the two and then compare that to the GDP of the United States, you get some horrifying data. Let me show you what I'm referring to. Back in 1930, let's say, we were under 10%. Again, that is state, local, and federal government spending. But you guys know what happened during the Great Depression in the 1930s. That went straight up, especially when you combine that going straight into World War II. Now this peak is World War II. We go back down, but notice we don't go back down to where we were before. We have a new kind of high water mark. And then we start trending higher and higher and higher and higher till we get to the point where we're right here in the 1970s. Now we kind of flatten out, but you'll notice more recently, because the government and the Federal Reserve, the central planners, have taken a much more proactive approach during things like the GFC, when we have an economic slowdown, you see the government spending accelerate. And we have seen that in spades. We have seen that in steroids. We saw that 10x during the cerveza sickness, where the government spending and the deficits went parabolic. So where are we right now? Currently, or at least in 2020, we're at 46%. Now you might be saying to yourself, okay, George, well, that's probably come down a little bit. No, it hasn't. If we look at more recent data, we see that we're still hovering right around 46, 48% government spending in total relative to GDP, or the economic output for the United States. Why is this a problem? And how does this take us into an economic doom loop? Well, let's go into a thought experiment. Let's assume for a moment government spending was 100% of the economy. 100%. Well, where does that put us? Is that socialism? Is that communism? Is that economic fascism? I don't know what you want to call it, but when you have an economy that's effectively 100% centrally planned, that is an economy that is incredibly inefficient, to say the least. So an economy that's inefficient is going to produce fewer goods and services. At the end of the day, money is not wealth. And we know this by looking at Soviet Russia. We go back to the 1950s, the 1960s. When I was growing up, we saw all these black and white pictures of people standing in line, Russians standing in line at the grocery store just waiting to get a loaf of bread. And I always assumed it was because they were poor or they didn't have any money. No, 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 no. They had plenty of money, but there was no stuff. There was no bread. They didn't have any goods and services because their economy was extremely inefficient. So if the amount of stuff, the amount of goods and services an economy is producing is going down, by definition, the standard of living is also going to go down. Well, we know by looking at this chart, going back to the GFC and the cerveza sickness, that if we have the standard of living going down, or an economic contraction, recession, whatever you want to call it, what's going to happen to government spending? It's going to go higher and higher and higher. It's going to go parabolic. I can assure you, the next time we have a downturn or a recession or a financial crisis, the government is going to spend so much money, it's going to make what they did during the cerveza sickness look like something out of a Milton Friedman textbook. And this is the key to this step, at least. This is the doom loop that I'm referring to. The more the government spends, the less efficient the economy is, the lower the standard of living goes, which prompts the government to become even more proactive, because they're all Keynesians, and spend even more money, which makes the economy less efficient, and it takes you right back into the feedback loop. So the question becomes, how fast is this likely going to accelerate? If you look at projections from the government, they say federal spending will likely go up to 31.8% by 2050 or 2051. I don't have the chart in front of me. I'm sure the editor will put it up right here. But I think this is a complete joke. This is a fantasy. In my view, we're going to get to that level and probably a lot higher by 2030. Let me show you what I'm referring to. Right now, we're about 46, 48%. But let's assume that in the next 5 years, we actually do have a recession. And let's use the cerveza sickness as a playbook. Right there, that was $5 trillion in deficit spending, maybe even more. So let's just assume the next downturn we have, they spend $10 trillion. Okay, fine, that's going to juice the economy, but the after effect is the government spending versus GDP as a percentage is going to skyrocket even further. It's going to go to that next high water mark, let's say. When you combine that with the government's own wildly optimistic projections that will only be 31.8% by 2050, I think by 2030, if I'm giving you my base case, I think we could be over 70%. So again, the way I'm coming to that conclusion is using the government's own trend line going up and the rationale they use for that trend line increasing, and then combining that with what the government has done in the more recent past, and then assuming that we will, maybe in the next 3 years, 5 years, whenever, have an economic downturn or couple or a financial crisis, and that takes you straight to 70, maybe 70+% government spending to GDP. So we're not at 100, but we're very, very close, and we're headed in that direction. So just to make sure we're all on the same page, I want to take a step back and kind of reframe this, because we're talking about a lot of statistics, a lot of numbers here, and looking at this chart. But just using common sense, if the government is responsible for 70% of the economy, that means the private sector, which is the only part of the economy that's efficient in creating goods and services, creating wealth, is only going to be 30% of the overall economy. And even if we don't go up, it's still only 50% of the economy, which in and of itself isn't good. Step number 2. Now let's go over this, looking at it through a financial lens. And I'm going to show you why it's so difficult to invest as government spending is going higher and higher and higher, and why in this type of environment, most retail investors will likely get crushed. For the Reader's Digest version, let's go right back to my blonde friend.
Government spending leads to higher inflation, which forces investors to take more risk just to maintain their purchasing power.
So to illustrate what she's saying, let's go all the way back to 1880. We're going to look at a chart from 1880 to 1900. And this black line at the top represents the increase in the money supply. And this red line represents the CPI, or the inflation rate, or the price level of goods and services. So we fast forward, and this is cumulative, by the way. So we fast forward to 1900, and we can see the money supply went up by over 250%. You can see this last dot kind of stops short. If I'm just eyeballing it, it was probably closer to 260%. So let me say that one more time. From 1880 to 1900, the money supply in the United States went up by, let's call it 260%. This was on a gold standard, mind you, but that's a topic for a completely separate video. Now, most of you are probably saying to yourself, well, my goodness gracious, if the money supply went up by 250, 260%, then prices would have gone parabolic. I mean, we would have had hyperinflation. Well, let's look at what prices actually did, and we can see they went down by over 20%. So how is this even possible? We can have the money supply increase at over 250% and prices go down by over 20%. The answer is because the economy was so efficient. The economy was so efficient at creating goods and services that even though you had the money supply increase by, let's say, this much, the amount of goods and services increased by this much. So prices actually went down. Now let's compare that to, let's say, 2000 to 2020, when the Fed was doing QE1, QE2, QE3, when we had all of the government bailouts for the GFC, and we had Greenspan take rates down to 1%, which could have contributed to the big housing bubble we had, the dot-com bust, all of these things, all this insanity. Let's start again by looking at the money supply, the black line, and from 2000 to just before the Cerveza sickness, we're up 233%. Let me go ahead and repeat that. We were up 233%. Now remember, from 1880 to 1900, we were up over 250%. In other words, the money supply increased more from 1880 to 1900 than it did from 2000 to 2020. But now let's look at the red line. We can see that prices, and this is if you believe the government's numbers, increased by a total of 53% during that time. So you've got two 20-year time frames. One, and let's just say they've got similar increases in money supply. One where prices went down by 20%, and the other where prices went up by 50%. Well, you have to ask yourself, what's the difference? And the answer is exactly what we talked about in step number 1. It's government spending. Back in the late 1800s, the government spending was, let's say, 5%. So 95% of the economy was the private sector. That's why it was so efficient, and that's why it was able to create so many goods and services that even with that money supply increase, prices went down. But you fast forward to today, when we're at 50%, and in my view, headed straight to 70 or more, then the government constrains, the government constricts the private sector. It can't produce as much stuff. It's not as efficient. So if you have a similar increase in money supply, instead of prices going down, they go up. So what does this mean for the investor? Let's go back to our chart of the late 1800s and focus on this red line. And let's think about it a little bit different way. If prices are going down by 20%, so just to keep the math easy, let's just say 1 to 2% per year, but the interest rates that you're being paid on a checking account are maybe 3 or 4%, which they were back during this time, by the way. You're getting a real rate of return of, let's say, 4, 5, 6% just by putting your money in a checking account, for heaven's sakes. So that's almost zero risk. Where if you fast forward to today and we have prices going up at, let's say, 3, 4, 5, 6, 7% per year, and compounding at 50+% over 20 years, now all of a sudden you can't park your money in a checking account anymore, can you? And in reality, you can't even park your money in a T-bill or a treasury because the rate of inflation is likely going to exceed the interest rate that you're being paid, so your purchasing power is decreasing. So what do you have to do? You have to go into the stock market. Well, that's taking more risk, isn't it? And if we go into this environment where even if slowly inflation starts to creep higher and higher and higher, compounded over 5, 10 years, that's a big deal. And that's going to force people to go from bonds to stocks to whatever, let's say crypto,
that's even more risky. It pushes people out the risk curve. And the further people go out the risk curve, especially with the retail investor, the higher the probability is they lose money. So the punchline here is not only is this increase in government spending going to destroy the standard of living and the economy, it's also going to likely destroy the portfolio of a lot of retail investors.
Step number 3, based on everything we've discussed in this video, what is the best strategy to protect yourself, to build wealth, and hopefully to thrive, considering the government and its spending is going to make you take more and more risk just to maintain your purchasing power? Let's start by going over a chart going all the way back to 1970 to 1980. This is a chart of the 1970s. There you go. What is this? S&P 500, but it's not just the S&P 500. This is a chart that's adjusted for inflation, because at the end of the day, you guys don't really care if your asset or your investment goes up with the rate of inflation. You want it to exceed the rate of inflation because you want to increase your purchasing power because you're actually taking risk, right? Why would you want to take risk and buy something that just goes up with the rate of inflation when, let's remember, if you sell that asset, you have to pay taxes on it. You got to pay 20% capital gains. So think about that one for a moment. Let's say the inflation rate is 10% and you buy the S&P 500, it goes up to 10%, but then when you sell it, you have to pay capital gains. So your purchasing power didn't even go up at the rate of inflation. It was below. So these are a lot of the problems that investors face when the government spending is going higher and higher and higher and increasing the probability that the economy goes down as far as efficiency, standard of living goes down, but the prices people pay continue to go up and up and up. Okay, getting back to the 1970s here on the left, we go from 400 up to 900. Right around 1970, we're hovering around 800, goes down, but then if you would have bought the dip, you would have done pretty well, assuming you would have known when to sell. Because if you bought the dip and held it, like most people tell you to do, buy and hold, right? You listen to Dave Ramsey, or you listen to the mainstream media, you listen to influencers on social media, and they're all about just buy and hold, buy the dip. It's not about timing the market, it's about time in the market. Really? Tell that to the 1970s. Because if you would have bought the dip here and held, look where we're going. Straight down. And then, sure, you recover a little bit, but you're still barely up to the level where you bought. And then that doesn't take into consideration the rest of the 1970s, where it goes down, 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 down. Now, I know a lot of you right about now are saying to yourself, okay, George, well, you're just cherry picking data. That was the 1970s. Not really. I started with the 1970s because that's the inflationary decade most people think about. But this isn't the only inflationary decade we have had in the United States. Editor, let's go back to the 1940s. And we see that when you adjust for inflation, the S&P 500 went down there as well. Now, there could be some people that say, all right, George, well, you're going way back, and now the Fed is more involved in markets, and they're lowering interest rates and doing all these things, so you really are comparing apples to oranges. Okay, let's look at the 2000s. Editor, throw up the chart. If we look at 2000 to 2010, what do you see for the S&P 500 adjusted for inflation? It went down. In fact, if you go all the way back to the 1930s to 2020, you'll see that there were 4 decades where the S&P 500 went down, again in real terms. There were 4 decades where the S&P 500 went up, and 1 decade where it was pretty much flat. In other words, what you're doing, if you have this buy and hold mentality, you're buying the dip, is you're basically just flipping a coin. It's a 50-50 chance that you make money or you lose money. And if I'm an investor, I don't want to base my financial future on a coin toss. The next rebuttal I'm sure I'm going to get is people are saying you can't compare today to what happened back in the 1970s because today they're printing so much money. And the fact they're printing all this money and the Fed is doing quantitative easing, the government is spending like the drunken sailor, George. You even said it in step number 1 and step number 2. So therefore, because of all this money printing, it's going to make the stock market continue to just go higher and higher and higher and higher. And therefore, you got to buy the dip and you got to buy and hold. Okay, well, let's just look at the facts. Editor, go ahead and throw up a chart of the increase in money supply from, I don't know, let's say 1970 to 1974, when the stock market absolutely plummeted. And then we'll compare that to the money supply growth from 2020 to 2024. When let's remember, between 2020 and 2021, the M2 money supply went up by 25%. So my goodness gracious, that type of money printing would surely prevent the S&P 500 from going down, right? Wrong. When we look at the facts, we see that the money supply growth in the early 1970s, say from 70 to 74, was even higher than it was from 2020 to 2024. So what that means is if we can see the stock market absolutely plummet, and by the way, it went down in nominal terms as well, when we had money supply growth that was higher than what we've seen, then that doesn't mean that moving forward, it's impossible to have the stock market go down. Because even if M2 is going up, like we saw here, the S&P 500 can still go straight down. And that takes us to the next strategy that you always hear in the mainstream media, or people like Dalio, something like that, the all-weather portfolio. Well, I'm good to go, George. I'm hedged because I have a 60-40 portfolio. So I've got 60% stocks and 40% bonds. Fantastic. How did that treat you in the 1970s? Editor, go ahead and throw up a chart of the interest rate on the 10-year Treasury yield. We'll use that as a proxy, and we can see that went straight up. So if interest rates are going up, what does that do to the price of the actual bond? Well, that means it goes straight down. So in the 1970s, yes, you would add this nicely hedged portfolio that would have lost money with stocks, and it also would have lost money on bonds. So I don't know if you can call that quote unquote hedged. And I'm sure there is another portion of viewers that are watching this video right now and saying to themselves, ha, George, I've got you. You can sit here and talk about the S&P 500 and stocks and bonds, but what I am doing is I am taking 100% of my net worth and putting it into gold or Bitcoin. And although this may work sometimes, there's other times when it likely will not work. And most people, quite frankly, can't stomach that type of volatility. So the smartest people in the space, people like my good friend Lynn Alden, who is one of the top and definitely one of the smartest people in the Bitcoin space, she would never, ever, ever advise someone putting 100% of their portfolio in Bitcoin. That's definitely not what she does, I can assure you. And even the smart guys and gals in the gold space, I've never heard one person ever say put 100% of your net worth in gold or silver. So we know what not to do is buy and hold 60-40 portfolio or go all in on one asset. So what do you do? This takes us to the key of this entire video. So instead of time in the market, which is what you hear from everybody, it's actually timing the market. And it's actually timing the asset you own. When I say the market, most people think of the S&P 500, but this applies to each individual stock. This also can apply to real estate, pretty much any asset that you're putting in your portfolio. And you've got to do the opposite of this. You have to diversify. And what I mean by this is you have to be asset agnostic. So sometimes it might be wise to buy stocks. Sometimes it might be wise to buy bonds. Sometimes it might be wise to buy crypto or Bitcoin or gold, and other times it might be wise to buy commodities or real estate. The next thing you have to have in your portfolio is asymmetry. And hopefully with each trade or each investment you're making, this means you've got way more upside than downside. But unfortunately, this requires a lot of management. It requires hard work. But I can tell you right now that if you want the odds on your side, if you want to protect yourself, if you want to build wealth and thrive, it's going to take some work. The days of you just putting money into a checking account and making a 4% real return are over. In fact, those days ended in the 1800s. You also have to know what to buy. On this channel, we always talk about buying things when they're cheap and selling them when they're expensive. Most people do the opposite. Instead of buying $1 for 50 cents, they try to buy $1 for $3, hoping it goes to $5. And that, as my good friend and mentor Jim Rogers says, is a quick path to the poorhouse. But even more important than knowing what to buy is knowing when to buy and when to sell. This is the real challenge. And if you can master this, and if you can get proficient at these other things, then you have a really, really good chance of not only building wealth, not only protecting your wealth, but actually growing your wealth into the future, regardless of what these crazy governments and central planners are doing. Now, I know this may sound overwhelming, but I can assure you it's actually quite simple to set up your portfolio in this way. It's not easy, but it's simple. And the good news is I have set up a private investment community with my good friends Lynn Alden, Chris McIntosh, Brent Johnson, Patrick Seresna, and Jason Hartman. It's called Rebel Capitalist Pro. And this is specifically set up to help the average investor just like you navigate everything we talked about in this video and set up your portfolio in this way so you have the highest probability, the greatest chance to not only protect your wealth, but actually to grow it into the future, regardless of what the central planners are doing at the government and the Federal Reserve. If you want more information on how Rebel Capitalist Pro can help you achieve your investment objectives, we'll go ahead and put a link in the description of this video.